I'll come back and fix the beginning part. So the statement allows 4 bases. Initial measurement and subsequent measurement. The first of those bases is historical cost. Yeah, historical cost. So the statement allows you to use historical cost as a basis for your frame, for your measurement. The second basis that it allows is current cost. Current cost. So historical cost and current cost. That's the cost today. It also looks at realizable value, NRV, net realizable value. Current cost and realizable value sound the same, except that in the one you are selling an asset and in the other one you would be buying an asset, isn't it? So net realizable value is what I can sell something for. Current cost is what I need to pay to buy something. And then the last one is present value, and that's to take into account any time value of money issues that you might have. All right, so just to revise then, framework, because I forgot to switch on the mic. Let me actually check that it is working. Yeah, it is. Our framework is our skeleton to our financial statements. It comprises mainly qualitative characteristics and accounting treatment. Qualitative characteristics, there are 2, fundamental and enhancing. Fundamental being the most important, enhancing being the nice to haves. Yeah? But ideally, we want to have all 6 of those. Our financial reporting, our information should be relevant, should be faithfully represented, true. It should be timely, comparable, verifiable, and understandable. Then, accounting treatment is 5 steps. It's always 5 steps. Definition, asset liability, equity, income or expense. We always start there. And often when you get a question, you will be looking at 2 of those at least. So you would be looking at whether something is maybe an asset or an expense, or whether something is a liability or income. Yeah. Definition, you'll know already from first year. Recognition criteria also we covered in second year, probable, measurable. Then our measurement bases, there are 4. And then the last step of accounting treatment is presentation and disclosure. It's how we present this information then in our financial statements. Presentation and disclosure is not covered in framework at all. Presentation and disclosure is covered in Companies Act. It's covered in IFRS, in the different IFRS standards. It's covered in King. It's covered in King. Corporate governance tells you what kind of disclosures you need to do. It's covered in JSE rules. The JSE rules sometimes tell you what disclosures you need to do for listed companies, and sometimes in industry regulations. So for example, if you're in banking, there's certain disclosures that you need to do because of industry regulations. So presentation and disclosure is not covered in framework. It's covered in all these other places. And when you learn about these other sections, that's when you will learn about what specific disclosures there are. All right, so framework, it's the same thing every year, isn't it? Every year we learn exactly the same thing about framework. There's nothing really new. So what changes actually with framework is the kind of questions that you get asked. Yeah? If you think back to first year and even second year, a lot of the questions you would get asked would be theory, isn't it? Recall. It's called pure recall. So you would just get asked to say what the definitions are, what the recognition criteria is. When we move into third year, the questions start to become much more applied. So if we're looking at framework questions, and there will be a framework question in your exam, right? It's an applied question. It will be applied. It will be to discuss accounting treatment, or to discuss or recommend how to account for a transaction, or advise advise management on whether the way that they have treated a transaction is correct or not. Yeah. So when we look at this framework questions, because they're applied, we follow this thing called a 5-step approach. A 5-step approach to answering questions. Yeah? The 5-step approach is what you will always use when you answer questions to do with framework. In fact, when you answer any questions that are discussion questions to do with any kind of legislation or regulation. So I would use this approach if you were in auditing, for example, to answer questions about the Companies Act or about governance. I would use this approach to answer questions about auditing standards, about any law in tax, even if you were asked to discuss compliance with VAT or something like that. So the 5-step approach is the facts. First of all, the facts. So let's say, for example, I like to use this example, a company that sells fast food has come up with a new recipe for a hamburger. Yeah? And so they've come up with this new recipe for this hamburger, and they've done a lot of trial and error, and they're advertising it in all their different stores, this fancy new hamburger. And now what they want to do is they want to take a whole lot of costs that they say they've incurred in launching this new hamburger, yeah, promotional material, free samples, all of that kind of stuff, and a portion maybe even of the chef's salary, because he invented this hamburger, and they want to recognize it as an asset. Yeah, they want to put it in as an intangible asset, a recipe. So the facts that you would say when you were starting the discussion question is you would say the company has come up with this new recipe for a hamburger, and they want to recognize a certain amount as an intangible asset. Facts. Step 2, theory. You then start your theory, and at this stage your theory is going to be just framework. Yeah, your theory is just framework. Later on, you're going to start to mix up this theory. It'll be framework. It might have some Companies Act. It might have some other standards. It'll be mixed. For now, it's just framework. What does framework say? And remember, framework mainly talks about definitions and recognition. So you would say, framework says that for an asset to be recognized, it needs to meet definition of an asset. An asset is defined as a resource controlled as a result of a past event from which there will be a future economic benefit. And it needs to meet recognition criteria. Those benefits need to be probable, and I need to be able to measure the cost reliably. Yeah? The facts. And there are marks just for regurgitating those facts. Step 3 is application. Apply. Apply facts to theory. And this is where all the marks are. Yeah? This over here, apply, is where all the marks are. You're going to say where it meets and where it doesn't meet, isn't it? So you will say, do I have a resource? Yes, I do. I have a recipe, isn't it? Do I control it? Probably yes. If it's a secret recipe, nobody else can sell it as that. It is mine, isn't it? Will there be future benefits from it? Yes, there will be. That's why I have this recipe that I think I control. Was there a past event? Yes, I came up with this recipe. I gave it a name, isn't it? I've been advertising it. Does it meet definition criteria? Yes, maybe it does meet definition criteria. And so you go through one by one by one by one, and that's where all your marks are, isn't it? When in this particular instance that I'm getting to, that I've come up with, the problem is going to come with recognition, because even if we could say what the probable future benefits are, and probably we can, the difficult part comes in measuring reliably. How do I measure what it cost me to develop that recipe, isn't it? Unless I followed that whole research and development intangible thing from FAC3701. Otherwise, it's really difficult to say what really did it cost me. I have advertising, I've put up boards, isn't it? But how much of that is to do with the recipe, and how much of that is to do with advertising sales that happened today, isn't it? How much is expense, how much is asset? How do you know? And so when you come to recognition, that's when you fall apart and the whole thing falls apart. And then step 4 is your conclusion. Students will often want to jump into conclusion. And what can happen is that they say to you, can we recognize this as an asset? And you'll say, no, we can't. It'll be the first thing you say, isn't it? No, it can't be recognized as an asset because wada. Your conclusion may in fact even be correct, but you'll earn 1 or 2 marks for that, isn't it? Somebody else who's gone through this whole process and identified all the definition conditions and the recognition ones and done the application and all that, they maybe by the time they get here have already earned 7 marks, isn't it? And now maybe they come even to the wrong conclusion, but they will get 7 out of 10 or whatever, and you'll get 2 out of 10 and you'll have come to the right conclusion. Why? Because you haven't shown me that you understand the theory, that you can apply the theory to the facts and come to a conclusion that's supported, isn't it, by whatever you've discussed. You've just jumped into the conclusion. When you jump straight into the conclusion, the other difficult thing is that it's difficult to come up with lots of reasons why, isn't it? Because all you're looking for then is reasons to justify what you've concluded, rather than starting from the beginning and saying, this is all the reasons it would, this is the reasons it wouldn't, and so therefore my conclusion is this. So always make sure that you follow the approach down and that you get to the conclusion at the end, not at the beginning. The last step is recommendation. Recommendation is not always a required. It depends on what the question asked you to do. But if they asked you to discuss and recommend what they should do, then your recommendation would be basically your journal entry, isn't it? What do you recommend? And in this case, your conclusion would be that that recipe doesn't meet the definition of an intangible asset, that the expenses incurred don't or can't be recognized as an intangible, especially all the advertising and point of sale and all of that. And so your recommendation would be that that amount gets expensed, isn't it, to expenses for the period, advertising or marketing or whatever. So you will do this 5-step approach for any question that you get asked. You will be asked a question in the exam. The questions are, I'm going to say plus minus 7 marks. It's more or less there. Sometimes it's a little bit more, sometimes it's a little bit less. And the approach, of course, to your question has to be to first of all understand the facts, isn't it? When I'm understanding the facts, so when I am looking here and understanding the facts, I'm going to try and understand what did the client do? What journal entries did the client pass? What did they actually do? So that I can say, this is what the client's done. Yeah, that's my facts. And then go into theory and apply. There's a question in your study guide. You can see it's quite a big question. Question, example 2 it is. It's on page 104. So the required says, discuss whether the city has correctly accounted for the above events in terms of framework. Yeah. When you read the story, I want you to read the story and try and understand what happened. You'll see it's quite a big convolute. I mean, you can see the story. It's quite a big story, right? And they've even given you some journal entries, the journal entries they passed. And you'll see that the journal entries that they passed, if I just look briefly at that, they created an asset. Do you see that? And they settled, or they converted a loan into an asset essentially. So we're dealing with asset. But we also are dealing with honoring network airtime. So there's also possibly some liabilities. I want you to consider all the elements of framework. I want you to consider, are there assets? Are there liabilities? Are there expenses? Is there income? When you're going through the steps to see what should be recognized and what shouldn't. All right, so I like to draw pictures. I'm going to let you have a bash at that and try and draw your picture. Page 104. It's a discussion question, And it is a big discussion question. I want you to just briefly have a look at the solution, just not for content, but for size. And there are 2 pages of answers. Look, this is the first page, page 105, and then page 106 is another piece of page. So the solution is 2 pages. So it's not a simple thing. It's not just like, a couple of points. All right. So what's a pity always when they give us questions in the study guide and that is that they don't give a mark allocation. So it's difficult to see how many marks that would be. But I would imagine that this would be about 14 marks because there's an asset and a liability. So we're looking at about 7 for each. Okay. So I'm going to let you do that. Okay, let's have a look. It was quite a convoluted story, isn't it? It had to do with one of the cellular companies that went into liquidation, and then another cellular company agreed to take on those customers and honor the airtime they'd already bought, isn't it, or they'd already paid for. And then they tried to then convert a loan that they originally had given to this company into an asset, which they said was an intangible, because it represented future benefits that they were going to get because of this announcement that they'd made to the existing customers. So already, like when you see it, you're thinking, no, it's not right, isn't it? However, the marks are not in the, no, that's not right, you can't take a loan and convert it into an asset. The marks are in the discussion. So when you look at the solution, it starts with theory. And it starts with the definition of an asset as per framework. This could be worth between 2 and 4 marks, because it could be a mark each for each of the points, or half a mark each, right? So that's your initial marks, is your theory. So they start up here with the facts. The questions are the following: can the loan be converted into an asset? Does a liability exist for the network airtime? That's the facts of the question. Then there's the theory. So that's step 1. Facts. Then we have here the theory, and then we have the application, and that's where the bulk of the marks will be, in the application. And you'll see what they say is that there is a resource as a result of a past event, but that unless they obtain the right to be the sole network provider, they can't control this right. So they say there is a resource, there is a past event, but there's no control. And that was one of the requirements of the definition. So they say that there is no control. Control cannot be ensured. Immediately here you could already conclude, isn't it? But I mean, we want a full discussion of all the points. So that was your first problem. Future economic benefits will flow. They wouldn't have done that if they didn't think they were going to get future benefits from it, isn't it? They wouldn't have been the nice guys and offered to honor airtime. It is probable that future economic benefits will flow, but the problem is that they cannot be measured reliably, and that was our second problem. So we had 2 problems, one with control, one with measured reliably, but at the same time, there were marks for all the other pieces, isn't it? So if I look at, I don't know, I'm trying to find a color that will work here. If I look at all the other pieces, there is a resource. They say a resource exists. They say there was a past event, so that one was definitely there. They say that future economic benefits will flow. They say that it is probable that there will be future economic benefits. So you can see, of the 4 criteria for definition and 2 for recognition, the 6, there are 4 that meet and 2 that don't meet, isn't it? But all we needed is 1 that didn't meet, and then we don't meet. So then they have the conclusion, apply, conclude. The conclusion over here, that because of the uncertainty about control, an asset can't be recognized. Then for this particular question, a lot of students, this was actually an honors question. The honors question was almost identical to this, but it was an airline. It was around the time when those airlines were all going bust, isn't it? So it was an airline that went bust, and a bigger airline that offered to make good those tickets. But obviously there were conditions about when you could fly and the whole thing. Just like here, there were conditions, isn't it, about when you could use the airtime. But the students, a lot of the students, what they missed was whether there was a liability. So in this case, the question is, we've committed to something, will there be costs? Because we've now committed to that. Because if there are costs, we've now got a liability potentially, isn't it? Definition of liability, a present. So again here, facts, theory, what is a liability? It's a present obligation, a past event, an outflow of economic benefits. The test about whether there is a liability or not, they're saying that there is a present obligation because of a past event. The past event was the announcement that were made, and it creates a present obligation. It is probable that there will be an outflow of economic benefits, like admin expenses. They probably will, they'll need to set up a little call center so people can call, isn't it, to activate. It should be possible to make a reliable estimate, so it should be possible to measure it. So in this case, all of the conditions are met, and so in this case they say that there is a liability and it should be recognized for those costs. I'm assuming the costs aren't going to be massive, isn't it? I don't know. It doesn't sound like massive costs. For you to meet that, your current network will meet it, isn't it? If there are costs, it will just be administrative, sort of back office type things. All right, so that's an example, quite a big one, isn't it, of what would be in an exam. But I wanted you to see how it gets examined, so I've made some copies of past exam papers we can have a look at quickly. You will be getting a TUT letter with past exam papers eventually. Yeah, eventually. So let's have a look. So the first page that you have there is page 6, 7, page 6. All right, so you'll see that. And now, question 1, rainbow red. Oh, I opened the wrong one. Sorry about that. This one that I want to open. So the first question that you have is a question called Capresso, and you'll see that the very first required says motivate with reasons why the issue of preference shares should be recorded as a liability according to framework. Yeah. Capresso, if you have a look at just above, no, to the, where's the story about the issue of preference shares? Right at the beginning. So if you look at the previous page, right at the beginning here, they say to you that there were 200,000 redeemable preference shares that were issued, and they're compulsory redeemable. The preference shares were declared, preference dividends were declared and paid to all preference shareholders. And so you needed to go and see whether we have a liability or not. It was worth 5 marks. 5 marks. We can have a look at the solution. If you look at the back of your page, you'll see I've put all the solutions in. Now, it always seems to me that the solutions are, like, the solutions follow the framework that I've given you, isn't it? I don't know how it's so few marks for such a lot of writing, because it's only 5 marks. But if you look at it, it starts with the facts of the question. In order to recognize the preference shares as a liability, it must meet definition and recognition. There's the theory, definition criteria, recognition criteria of framework. Then the discussion, the application. In order for it to meet the definition, there needs to be a present obligation as a result of a past event. and there will be settlement, and they talk about how they all meet. They say they do have a present obligation because they're redeemable. There was a past event because they issued the shares. There will be settlement of future benefits because they will pay an annual dividend. And the outflow is probable and the value can be measured reliably. And then they come to a conclusion that it does meet definition and recognition criteria, and so it should be a liability. So it's quite a lot for 5 marks, isn't it? But you can see they do follow that 5-step approach. So that's the first one. That's there. You'll see that every single exam, there were a couple of exams in this paper. So you saw it was question 1 that had the first question. Then you'll see the next one is question 4. The next exam also has a question. Also again for 5 marks. Discuss the reasons, if you agree with the FD, whether the insurance costs should be a liability in the statement of financial position according to framework. And each one will be completely different. So this one, if you read point 3.1, you'll see is about self-insurance. The financial director cancelled the insurance policy and decided that they would self-insure in future. This was due to the fact that they had made insurance. They had been paying this insurance and hadn't made any claims ever. So this you do sometimes see companies, especially big companies with lots of vehicles, let's say, will decide to self-insure. Why? The money that they pay to insure all the vehicles, if you work like on a probability of how many vehicles will be in accidents, you might save some money if you just cover your own insurance, isn't it? So we can't do it. We own one car, isn't it? It's just too much risk. But if you have lots of vehicles, you might find that you just keep paying and never claim, isn't it? So he decided they were going to self-insure. And even though they hadn't made insurance payments, what they decided to do is that instead of paying that 15,000 Rand a month, they would still expense 15,000 Rand a month and put it into a liability account, isn't it? So that was the question then. We've decided to self-insure. Does it meet liability? Because this is what they've done. They've debited the P&L with an expense, and they've credited an insurance liability. So you have to go through that process once again. And if you look at the solution, they, again, kind of follow the same approach. And they always follow that same approach, page 56. And it says, they start with the theory, a liability definition, present obligation, past event, future outflow of economic benefits, recognition criteria, probable, measured reliably, and then a discussion. So the discussion centers around the fact that there's no obligation. Who do we owe the money to? Who do you owe 15,000 Rand times 12 to? To nobody, isn't it? The first time that you have an obligation is if there's an accident and you need to fix a car, isn't it? And you've given it to somebody to be fixed. So the whole discussion is around the fact that there is no present obligation. There's no obligation at all. The company is not even obliged to repair or replace vehicles that are in an accident, isn't it? They could just decide, oh, that car was in an accident? Okay, well, let's just sell it, and we won't replace it, we won't fix it, we've got enough other vehicles. So in that case, then there would never be an obligation, right? So the whole discussion is around that, and then the conclusion is that, no, they can't meet. So you can see completely different, lots of different types, isn't it? But you just come back always to that same framework. So you'll see I've given you a few. The next one is about an expense. Repairs to furniture. Is repairs to furniture an expense or is it an asset? Yeah. It's really silly things, isn't it? But when you look at them, it makes you think. You have to think it through. So that one was expense. Question 9. So if I just go back, sorry, to question, what question was that? 7. Question 6, page 21. So question 6 was also 5 marks. Motivate why repairs should be recognized as an expense in the P&L. I mean, it's clear that it is an expense in the P&L, isn't it? Of course, the repairs is an expense in the P&L. From first year already, you knew that repairs was an expense. But now, in terms of framework, you need to explain to me why it is. Right, that was that one. And then the next one is 9, isn't it? Question 9. Question 9, I'm not going to go through all the details, is again 5 marks. Motivate why a provision for refunds should be recognized, should be raised in the records as a liability. Again, a liability question. They do like liability ones. We've seen a few now. Hey, this is the 3rd one that's been a liability one. Next one is question 11, I think it was. Question 11. And you can see we've more or less gone every second question, isn't it? Question 11. Oh, wow, this one was for 6 marks. 1 more mark. Motivate the reasons why laptops given to clients with the sale of 3G contracts can be recognized. Oh, no, that's revenue. That's not the one. It's number 3, it's not number 1. Motivate with reasons what the correct accounting treatment for the wage clock machines should be according to asset. So this one's an asset recognition. Wage clocking machines in additional information, number 2. That was number 11, question 11. I think I have 1 more. How many have I given you? Question, no, I think maybe 2 more. 12. No, just 12, isn't it? Question 12. I think I've put the solution first for that one. Question 12, also for 6 marks. I said about 7, so I see there's lots that are about 6. The financial director made a donation to the Animal Rights National Conference for 110,000 Rand. Now he wants to capitalize it and amortize it. So he made a donation and he wants to recognize it as an asset. And the reason for that, he says, is because the name of the company will be promoted. It will be on the billboards at the conference. And it's expected that the public image will benefit for at least 3 years. They come up with the funniest things. Discuss if the donations should be capitalized as an asset. I'd like to have a look at the solution for that one, because they're asking you about whether it's an asset, isn't it? Your conclusion is really that it's a liability. Do you agree? An expense, rather, not an asset. But I don't think they don't go into expense at all. They just stick with assets, and then they say, if it's not an asset, it therefore must be an expense. That's exactly, oh no, they just say it doesn't meet and can't. There's the donation, there's the facts, there's the definition of asset and recognition criteria, the theory, and then here's the application. And it's all about control and those future benefits that we can't establish, isn't it? How do you know how much that promotion is worth to you in terms of future benefits? You don't know. And so since it doesn't meet the definition of assets, it can't be capitalized or recognized. You know, when you look, I don't know how many of you do remember an ad that was on TV. It was for Cremora. It was, it's not inside, it's on top. Do you remember that? It's not inside, it's on top. I'll never forget that ad. And it was something that ran for quite a long time. And then Cremora sort of stopped doing ads. You didn't really see the ads. But those ads kept that name, that brand, in the spotlight for a long time, isn't it? And it's always a challenge for companies that do a lot of marketing, for branding companies. Like Coca-Cola spends in excess of 100 million Rand a year on advertising. And that 100 million Rand, some of it is just to generate sales in the summer months or during Christmas or during Easter, isn't it? But some of it is for brand sustainability, to create and keep that brand awareness, isn't it? And how do you know how much is what? And that's the key thing with advertising. There is enduring benefit in advertising. There has to be, otherwise companies really wouldn't do as much as what they do. But the difficult thing is knowing how much. How do you know when they advertise Coke and they do those fancy ads? Remember there was one that looked like Willy Wonka, isn't it? How do you know how much of that is enduring benefit and how much of that isn't enduring benefit? How do you determine whether your sales increased or didn't increase? I remember sitting in a meeting with the marketing director of Coke, having these discussions with him, and it's something that they think about, isn't it? They think about, We spend 100 million rand on advertising. How do we know what benefit we're getting out of it? How do we measure whether we're successful or not? Isn't it? It's a difficult thing. And from an accounting point of view, it comes back to that. It's difficult to say, and so therefore we can't. Because with accounting, it's very clear. Unless it's probable and you can measure it reliably, it can't come in. Then it must just go expense. Okay. So you can see I said 7 marks, but it will be in every paper about that. You know, it's not masses, right? Okay. Then IAS 1 is the last bit that I want to do today. There's just a couple of things I want to touch on IAS 1. You've also done IAS 1 to death. You will never, ever be asked an IAS 1 question. IAS 1 is presentation of financial statements. Presentation of financial statements. And there's just a couple of things on presentation of financial statements that I want to touch on. Okay, so basically IAS 1 just talks about the fact that our financial statements are made up of a statement of financial position, a statement of comprehensive income, a statement of cash flows, a statement of changes in equity, and notes. Yeah, it talks about the fact that you need to do all these statements and you need to do comparatives for the statements. Comparatives are the prior year, and there's a little exception which is dealt with in IAS 1, but we've talked about already, and that's that for statement of financial position, we do 3 years if there's been a change in accounting policy. We dealt with that when we did accounting policies, hey, but the requirement for that 3rd year is here in IAS 1. IAS 1 is also the statement that talks about going concern and accrual, the 2 bases of accounting treatment, and that is going concern. Our financial statements are based on the going concern principle and on the accrual principle. We don't account on a cash basis, we account on the accrual basis, the going concern basis and the accrual basis of accounting. Okay. What else does IAS 1 do? IAS 1 is also the statement that requires disclosures of dividends. We, in FAC 3703, we deal with dividends per share and the disclosure of dividends. And IAS 1 is the statement that deals with dividends. Dividends proposed, dividends declared, how to present and account for dividends. Although you don't really need to know that in a great amount of detail, just to know that that is what's in IAS 1. IAS 1 also deals a little bit with aggregation, materiality and aggregation, and it talks about aggregate and offset, and it deals with the rules around aggregating and offsetting, and it basically says that if you have not material items that are similar, you're allowed to aggregate them. And it also talks about the fact that if you have if it's a legal right that you have to offset, that you're also allowed to offset. So for example, if you buy from somebody and sell to that person and you've agreed that you will settle on a net basis, isn't it? Then you can take that receivable and that payable and show the net receivable or payable. For example, if you owe SARS money for PAYE or for tax, but they owe you money for VAT, they're both SARS accounts. Hey, we keep the VAT one as a receivable, we keep the other one as a payable. They are separate assets and liabilities. We don't offset, isn't it? So there are very select times where you're allowed to offset, but this statement just talks in general about offsetting. I think that was it really that I wanted to touch on. I've never seen anything about IAS 1 examined, other than the fact that they can ask you for a P&L and they ask you for notes, isn't it? And some of the notes, when we're looking at notes, for example, the profit before tax note is dealt with predominantly in IAS 1. Yeah, you remember it from FAC3601 when we looked at presentation. That's when we looked at that profit before tax note. So if you look at your handout, you'll see that under each one, we talk about what should be disclosed on the face and what should be disclosed in the notes. Yeah, so it's basically your first standard, your very first standard that just talks about financial statements basically as a whole, what they should look like, what should be on the face of the financials, what should be shown as in the notes, additional information. And then from here we go into our standards. And our next standard is IAS 2, which you remember doing in second year, which was inventories, isn't it? The IASs are being replaced by IFRSs, and that's discussed in your, if you look at your study guide, there's a section, one of the learning sections, learning unit 4. Let me find the page. Page 109. And it just gives you a little bit of a background about international accounting standards, the board of international accounting standards. So there used to be a board that was issuing international accounting standards, right, IASs, and then the board was changed, and it then became the IASB, and the IASB has started to revise all the standards, and so their standards are now called IFRS, International Financial Reporting Standards. It used to be that every country had their own GAAP, their own accounting standards. South Africa had, when I was at varsity, when I learned standards, our standards were called AC1 or AC whatever, accounting standard 1, those were the South African standards, accounting standards. At the moment, what we still have is most countries, or a lot of the countries, have adopted international standards. In South Africa, we've adopted international standards, with the exception of some things that are specific to South Africa, like, for example, if there's a JSE rule about something, then there would be a South African standard for it. There's a South African standard, for example, to deal with BEE transactions, because that's not something that we would see in any international standard. But the one country that hasn't really adopted international standards is the US. And you'll still often hear the term US GAAP. I don't know if you've heard referral to that. I knew a girl, she was like top at UJ in her year. She came like top 10 board. She used to spend about 6 months of her year at Anglo Gold. And all she did was convert the statements, the financial statements, into US GAAP. So she was a real boffin as to how US GAAP differed from international standards, and she did the conversion, isn't it, the change in policies and accounting treatments to get from, because the Anglo Gold was also listed in New York, so companies that are listed on the New York Stock Exchange have to issue financials in accordance with US GAAP. And it was listed in South Africa and in London, and so there it needed to report according to IFRS. And then ours are in rands. In London, it would be in pounds. In the US, it would be in dollars. So she'd have to do all of the conversions and the restatements for the accounting treatments. But I think that what they're trying to do when they look at the IFRSs is they're looking at how the IASs maybe did differ from US GAAP, and they're trying to align it, isn't it, so that we have one sort of recognized accounting standard that's used worldwide. I just want to point one thing out to you. If you turn the page, if you have a look at page 112, it's something that we don't cover almost at all in our syllabus. But there's an IFRS for SMEs, small and medium enterprises. So there's a statement which is called IFRS for SMEs. It's a much simplified way of doing accounting. For example, deferred tax, they do very simply. Yeah. And you can see that in terms of the different companies in South Africa, some companies would be allowed to do IFRS for SMEs. And how they decide is by looking at the public interest score. So a company that just is family owned and the financial statements just go to the family and to SARS doesn't have to follow all these big IFRSs that we have, isn't it? They can just do a simple one. All right, so let's just look at where we are and where we're going, what we've got left to do, because we're almost just about done. So we spent a lot of time on study unit 1 and 2. We spent 3 weeks on each almost, isn't it? No, 2 weeks on study unit 2. I've now done study unit 3, 4, and 5 in 1 week, but it's like 5 marks in the exam for all 3 of those, isn't it? Whereas income tax is like 30 marks in the exam. So we left with 6, 7, 8, and 9. So 4 big sections, or not big sections, 4 separate sections of work. 6, 7, 8, and 9. 6 is 6 events. I'm going to do 6 and 9 together. Yeah? And that's going to be, I was going to say that will be 1 lecture. This week is week 6, isn't it? Week 6. Yeah, this is week 6. Yeah, no, maybe I won't. Maybe I'll do them separately and we can just do past exam papers. But events and fair value measurement are both small sections of work. It's just disclosure. It's no accounting whatsoever. Yeah? Events after reporting is just a note in your financials to say this is what's happened after reporting date, and I think it's material and you should know about it. Fair value measurement is a standard which is just theory, and it talks about how do I measure fair value. Not that we use it in this module, but we'll use it in FAC3701 when we do revals, isn't it, and investment properties. Then number 7 deals with provisions. That's a big standard, provisions, and that will be some marks in the exam. And number 8 deals with revenue, accounting for revenue. Revenue recognition is the main thing. So that's going to be 4 topics, standalones, that we're going to cover in the next. Is it the other way around? 8 and 9 are the other way around. Fair value first, and then fair value first, and then revenue. Okay, so that's going to be the 4 lectures that we have remaining. The topics are not big, but what we're going to be able to do from now is we're going to be able to start doing some past exam papers. The exam papers are all integrated, so it's difficult to find an exam paper that doesn't deal with provisions, for example, or with events, isn't it? It's all mixed up. So we're going to start working through this and start working through some past exam papers, and then we've got 3 weeks more still, because there's 13 weeks of lectures to just do past exam papers, and there we're going to work through the most recent ones. So for these ones, I'm just going to pick a question. That first one that I gave you in that paper, Capresso, is quite a nice question. It's about coffee machines, I think. Coffee machines. But it's a nice question. It's like a little bit weird, the way they give the information, so it's good to get used to things like that. Right. So that's where we are. All the hard stuff is done. So essentially I said to you already, hey, those first 2 topics, tax and changes in policy, is 2/3 of your paper. 2/3. The other third will be these bits. You saw framework 5 marks, provisions about 7 marks. It's more or less all that, little bits here and there. Revenue is where they like to ask journal entries. When we look at exam questions, and maybe this is a good time to just give you an overview, it is FAC3701. The way they can ask exam questions in financial accounting is they can ask discussion questions. Discussion questions here, framework, sometimes provisions, sometimes revenue. So they can ask you, should they raise a provision? They can ask you, how much revenue should we recognize? The second type of exam questions is presentation and disclosure. Your statements and your notes. Yeah? Presentation is your statements, your face, statement of changes in equity, statement of financial position. Disclosure is your notes. Number 3, they can ask you journal entries. And number 4, they can ask you calculations. And you're going to see a mix of all of these in this paper. Yeah? So in this paper, framework, they will ask as discussion questions. Revenue, they will ask as discussion questions. Provisions, they can ask as discussion questions. Presentation and disclosure, the tax notes, huge tax notes. The note for changes in accounting policy, it's usually more notes than presentation. Yeah, we don't normally see in this paper do a P&L. What they may do is say correct the profit before tax or something like that. But that's calculations. We also can see calculations. Do the deferred tax calc, isn't it? Recalculate the profit before tax after the change in estimate. that kind of stuff. And then journal entries is revenue for this module. Although we did see also in the assignment, we saw a journal entry to correct errors. But you will see all four in some combination or another being asked in this exam. Okay, that's the 4 ways they can ask exam questions. All right, that's it for today. If anybody has any questions on stuff we've done up to now, now's your chance. We've got a bit of time.